welcome to episode 194 of The Numbers Game. I'm Jace. I'm joined by Marty and Tommy. How are we going, fellas?
Going well, Jace. Nick Riley's where's he in? Barcelona, I think. He's somewhere very exotic on a real estate conference, just, talking up the good talk about Innovate, which is...
real estate conference. Come on, Marty. Come on.
Well, that's what it is. He's out there pressing the flesh. Just happens to be in a different country. So of course, when one of our own goes overseas, or we lose you in the midst of the various different fun things you're up to, Jace, our producer Tommy Jackett just jumps in and gives us a chop out. So Tommy, thanks for jumping in again, mate.
No worries, matey. I just I'm waiting for the pic of Nick and his budgie smugglers, which they would fit in well in Barcelona.
Oh,
yeah.
Mate. And he'll be there for like less than 24 hours. His tan will be glorious. His beautiful olive skin. He'll just be absolutely fitting in to a T over there.
And he would love us to talk about him and his budgie smugglers on YouTube. Like, let's get it.
Yeah.
We have to get some footage.
We'll put a pic in for everyone who goes to the YouTube channel. You'll see a picture of Nick and his budgie smugglers inserted right here. And now we'll get into the show. So I wouldn't be surprised if that's going to be our most watched YouTube video in the history of the Numbers Game YouTube channel. But if you're not following, now you've got a reason to get over there and check it out.
What have you been up to, Tommy?
Oh, mate, last time I spoke about my son, DJ Daka, but it's because kids absolutely consume your world, as you know, Marty. And you've got a cat, Jason, so it's pretty much the same, doing the same thing, shitting around the house, all of that.
I'm just a spare human, but no, yeah.
Yeah, well, I've just been with my son. He's DJing again, and he's had his second gig, which was at a nightclub in Bendigo. So we did a family road trip over the weekend, nice. And went to Bendigo, stayed in an old school motel. They're costing $300 to stay one night now, Marty. It's
really?
It ain't cheap.
Really? That's
wow.
In Bendigo. Wow, that's getting a bit exy.
Yeah.
Anyway, you got to do it for the kids.
Well, that's exactly. It. Well, no, I was going to say I went to the aquarium on the weekend, and my brother has a 3.5-year-old and a 1.5-year-old, little Hendrix and Chester, and watching all of the parents trying to decide what little fluffy toy to buy. They're $25 for a small toy from the aquarium shop, and I saw the skill tester machine, dropped $5 into it, and won 2 out of the 3 attempts. I pulled a toy out of the skill tester machine. So the first one came out was a little octopus, and little Chester, the 1.5-year-old, he just looked up and his eyes were like, yes, grabs the octopus, strolls off. He's happy as.
I was just going to say, is that dumb luck or luck, Marty?
Yeah, I was just thinking about that, Tommy. Jason's going to maybe one day experience that. They're called guilt gifts. When you know that the gifts are just going to end up on hard rubbish in about 3 years.
No.
But
3 years.
The kids got tears in their eyes if they don't get, a stuffed crocodile, and mate, you just know it's you.
Chester did not let this octopus go, and then my brother and his wife turned around and said, "You can't win one. We got 2 boys. Like you need to now win another one." And I'd watched half a dozen families just blow their money and not walk away with a single toy. So I thought it was dumb luck, not earned luck, but. Missed the second attempt, third and final attempt, bang, pulled out a purple tortoise. Hendrix ran off with that. And about 10 minutes later, he went over to Chester and said, do you want to swap and have a go at this toy? And Chester just grabbed the octopus and was like, nah, pal. Like I don't think it's left his hands in the last 24 hours. So successful weekend at the aquarium.
In these times, surely they could have held onto a leg each. That's the benefit of winning an octopus. Surely.
Oh. And then my brother and his wife can have a few more kids, and this octopus can really get put to good use. So, no.
Hard rubbish.
Well, it's great to have you join us, Tommy. And we're going to talk exciting things today. Hopefully, you'll get a bit out of this as well, as will our audience. We had a question thrown on the YouTube channel. Do you have that handy before we fire in, and that'll guide where we're off to?
Yes. So this question sets the tone of what we're speaking about today. So this came through on our YouTube. And it was in relation to bucket companies. Now, you've spoken about this before in the early days of the show, probably, I reckon, in the first 10 eps.
Tax Hacks, episode 10.
Yep, there you go, spot on. And so the question is, I'm not getting why bucket company is needed, as ultimately we are just delaying taxes as dividend will be distributed to individual ultimately at the time the individuals need to pay the tax on dividend received. Of course, they'll get franking credits. However, differential tax amounts need to be paid, assuming he is on higher slab rate because of what bucket company has been formed. So
Great
the thing
question.
is here, Jace, what I understand from that question is not a great deal, and that's because bucket companies can be quite complex, just from the outsider's perspective. But I know they are super beneficial because I've used one through you guys in my tax planning.
And it's interesting. It's interesting you asked that, because I was thinking this just the other day, going, okay, I get a fully franked distribution to the bucket company, but when one day I convert that, like, what happens to me as an individual, or to my wife as an individual, on that money? Am I paying tax again? Am I getting some sort of franking credit benefit? What is going on, Jace? I don't want to be losing money here.
Great question. And this is one way to get the accountant in the room really bloody excited to talk bucket companies and taxes. So
bucket us up.
Hopefully, if you've heard the Clementine episode, you'll understand that what we do is to make things simple for our clients. And Tommy, you're one of our fantastic clients at Future Advisory. So I'll do my best to make this simple and easy to understand for those playing at home on, the benefits of a bucket company, how they work. Marty, I didn't know your dad was commenting on YouTube though. So that's nice of him to ask that question.
Hi, Dad.
Mr. V, how are you? So first of all, bucket company. So essentially, the name kind of says it all. It's a bucket. You might have an operating company or a trading trust, and ultimately what is overflowing is these profits that have to come out of these entities at some point in time. And what we try to do, if we don't have an individual that we want to load up with all of the taxable income, because the individual tax rates are as high as 47%, what we're trying to do is use a bucket which has a cap tax rate. Now, the bucket company, which will collect these profits and hold for a later date, can pay tax at either 25% or 30%. Now, again, we've gone straight into complicated things here of why does a bucket company have two different tax rates. So just to nail that one, if you are a trading trust and you're a small business, you classify for what's called the base rate entity. And that's where you get to pay 25 cents to the dollar for a company. So the trust passes profits out of a trust through distributions. And if it passes it to a bucket company, the bucket company basically, it looks through the trust, and the bucket company can say, I'm an extension of that trust. So I'm going to claim the base rate entity too. And I'm going to do it for 25 cents to the dollar because I'm classified as the small business rules.
Can I stop you there? I'm just getting really clear on this and specific on this. Okay. So money's coming through, let's say Charlie Martin Proprietary Limited as trustee for the Vidakovic Family Trust. There's beneficiary myself, my wife Colleen, and then the bucket, Charlie Bucket Proprietary Limited.
Great name.
And so what's happening there is, do I get 30% on that or 25%? Just so I understand. So I have a corporate trustee.
If that trust was running a business, that trust would have qualified to be what's called a base raised entity, and it passes the 25% base rate entity to its bucket company. So that's where the bucket company gets to say, I'm kind of a flow on of a small business. So it gets the 25% tax rate. Now, on the other side of it is where you've got a bucket company that is getting profits sent from an operating company. So operating company is the small business, pays 25 cents. But once it flows to the family trust, your family trust then chooses the beneficiary. And it can be the mum and dad, the individuals, or the bucket company. On the second pass through, because it's left an operating company, gone to a family trust, and now going to a bucket company, that bucket company isn't allowed to flow on the first base rate entity from the other company. So it's going to pay 30 cents to the dollar tax. Now, again, won't stick on that for too long. 30 cents and 25 cents is better than if it went to the individual that year who may have been paying tax at 47 cents to the dollar. I've got a great real life example coming up as well.
Yeah.
So ultimately, to start off with, the real simple part is a bucket company is helping you pay less tax on additional profits that you don't want to distribute to individuals who are probably in higher tax brackets. That's kind of the basic fundamentals of that.
But if it's an investment vehicle, the corporate trustee is an investment vehicle, and the beneficiaries, myself, Colleen, and then the bucket, then that would be 30 cents in the dollar based on the fact it's not a trading company.
Correct. Yeah. So
I love that, Jace, because I'm on the exact opposite side of what you're saying, Marty, because I'm a trading trust with
Yeah.
myself and my wife as the trust, where we can distribute to the
Beneficiaries.
beneficiary. Sorry, I need
Yep. No, you're
my
right.
accountant to come in and just say the technical terms. And then I've
That's all
got
right.
now
That's
a
what I'm here
bucket
for.
company, so I get the 25 cents.
Correct. Now, yeah, but whereas if you were trading through a company, Tommy, you'd have to pay an extra 5 cents to the dollar top up because your company would have paid 25. Then the bucket company tops up the extra 5 cents because the franking credit from company 1, 25 cents already paid, into company 2 has a 30% tax rate and it doesn't get double dipped. It's not then paying another 30 cents. It's just the extra 5 cents. I think it helps to go straight into an example here how bucket companies can be used for tax minimization. So going through, this is the example of a family trust. Or actually, no, I'm going to back it off one. Imagine you're a sole trader. So Tommy, back when you were a young producer and you had your first booming big year potentially, and this is an example, Tommy, we might call it Dave, the other producer that we work with, just mucking around. So there's a sole trader, real life example. And we get a lot of actually Dave, the tradies who are sole traders. They've gone out, they've finished their qualifications, and they start working and they're on, full qualified rates. And they have their first big year as a sole trader. Now, Dave's got a wife at home, they're starting a family. But because Dave's a sole trader, he's just paying tax at the marginal rates. So on a $300,000 profit year, Dave used to be on a wage of 150 to 180. He would have all of his taxes withheld. He'd have super paid. But when he went out on his own, he absolutely boomed. All the boys at the footy club were sending him work and he had 300,000 profit for the year. Now, as a one sole trader taxpayer, the tax that he has to hand over, and we're using 24, 25 tax rates now because we've flicked over, he would pay $107,138 in tax on his 300,000 profit. He'd have less than 200 grand left over. So, he's gone to work for a year and he's given more than a third of all his hard earned has gone off to the government. And that's because everything over 190,000, he lost 47 cents to the dollar on. Now, Dave would come to someone like me if he was lucky enough to be referred to a good accountant who wants to make sure that you're paying the most legal, lowest amount of tax possible. And we'd say, Dave, let's set you up a family trust. And we'll see if you have another year like next year. And when we do tax planning, if you had another big booming year, we might set up a bucket company to help minimize your tax and keep more wealth in your family group structure. So Dave comes back the year after. We've set the family trust up. Another $300,000 profit year. Same profit, same Dave, but this time family trust with a bucket company. So the money goes into their joint offset account for Dave and his wife. We're going to distribute $100,000 each to Dave and his wife, and then the extra $100,000 that makes the $300,000, we're going to send that to the bucket company. Do you want to guess how much tax Dave, his wife, and the bucket company will pay, Marty?
On the 100?
On 300,000 in total earnings.
Oh, I don't know. On the bucket component, I'm thinking 25 grand, the 25%.
Bang on. Yeah. Not bad. Good math.
Yeah.
Cool.
You have to share the rest of it with me.
The total, so Dave and his wife getting $100,000 taxable income each, they've both utilized their lower tax brackets. So the 19-cent bracket and the 30-cent bracket. And again, these have changed now. So it's actually a 16-cent bracket for 24-25, then a flat 30% up to 135,000. So we've kept them at 35 cents or less. And then because anything over that would have been more than 35 cents, but the bucket company was 25 cents. So it made sense to send it there. Dave and his wife pay $22,788 each. Total tax, including the company, is $70,576. Dave, his wife, and their bucket company as a group structure have an extra $36,500 sitting in the bank that they didn't have to give to the ATO because they had a bucket company. Now, I'll tell you what, I mean, I think it was Kerry Packer said, anyone who gives more money to the ATO needs their head than what they legally meant to, needs their heads read. And I look at that and go, this is where the bucket company idea of keeping more wealth in the hands of a family group, which includes a bucket company, to allow them to not only do tax minimization, to do asset protection, but also to grow wealth through investments by using that bucket company as an investment vehicle, as you said, Marty. So before I power on with my lovely examples, any questions, Tommy and Marty, on the logistics of how that all works?
Pretty good with that. Yep.
I think there's a lot of people out there that, like myself and like Dave in that situation,
Yeah.
where you're losing so much money that you could be keeping for your family, and not it actually flows on beyond that. So if I kept all my profits as a sole trader, my tax bracket would be through the roof, and I would
Mm.
be paying exorbitant amount of tax. But what that would do, Jace, also is reduce my daycare
Yep.
payment from
Yes.
the government. And so this is the situation, Dave's situation. You've basically described me. You could have used my name, except I'm not a tradie. But that is like the identical situation for my wife and I.
Yep.
And we would literally have to pay the government back money
Mm.
based on the childcare subsidy, which is a scary thing to see a bill from
Yep.
the government about childcare, which happens so often, just
Yep.
because I
We
hadn't
see it
have
all too often.
done the tax planning with someone like you. So it makes a lot of sense.
Could I ask a couple of questions around it too?
Of course.
With let's say Dave, aka Tommy, does sensationally well the next 3 years, where his incomes continue to go up. He's holding that money in the bucket company. When does he distribute? Are there any consequences to distribute to his personal returns? And how would you think about that as an accountant to help a person in that situation?
Yeah, fundamentally, I mean, the comment on YouTube has some merit in a sense that if you're just kicking the tax can down the road, you're going to pull all that money out a couple of years later in the 47% bracket, then you've cooked it anyway. All you've done is delay the inevitable of giving the ATO more money. What the bucket company allows for is the flexibility of distributions. So let's say we've got a family group where husband and wife have 9 children, and a bunch of these kids are now turning 18. Now, again, Dave and his wife, Sarah, Dave and Sarah actually had teenage children, and they're about to turn 18. They're going to be living rent-free. They're going to be paying for their education. So then what happens is maybe that bucket company has an opportunity to start to distribute some money out to within the family group, because that money is now going to be used for education and supporting their children going through university, and they won't be paying board. So then legally, doing it that way means you distribute back out through the family trust, distribute to adult children who now have the same thing. They can have up to, again, you've got to be smart about the amounts. You can't just go stick 100 grand each taxable income into the kid's name if they're not actually going to receive the benefits of that money. A thing called Section 100A has come out, and it's quite important that accountants and the clients they do tax planning for understand the complexities of, you can't just throw money in someone's name and get them to pay the tax on it. They don't actually receive the money. So it's very important to sit with your accountant before 30 June and go through the ins and outs of where the money has to move, why it has to go to certain places, like the bucket company bank account. You can't just say, oh, I'm going to stick it in the bucket company, but Dave and Sarah actually spent it on a trip to Bali, or they've paid off their home loan. The money actually has to go to the bucket company, which I think is a big misconception. A lot of people go, oh yeah, my accountant set up a bucket company, but I've never put the money there. I've actually paid off my house, or I bought an investment property. Straight away, you're getting into the territory of, Div 7A, all these fancy accounting terms, Div 7A, Section 100A, but they're all really, really important things that you have to get right. If you go down the path of setting up a bucket company without actually understanding some of the risks and implications of not doing it right, or not having somebody in your corner who's supporting you, you can very easily get yourself into strife. And all of a sudden, the tax benefits of having that bucket company bite you in the ass a year or two later when you have to cop the whole distribution because you never put the money in the bucket.
So Jace, if let's say you distribute 100 grand and there's no other income to the individual for that 1 year, how are they taxed on that 100 grand once it comes out of the bucket company?
Great question, Marty. So I'll use an easier net figure. So we're going to distribute $75,000, and that's going to come with $25,000 of franking credits. So an easy way to explain this example is, imagine that first, a little bit convoluted. Imagine that first operating company had 100 grand profit in it, and it gave $25,000 off to the ATO. So it went from 100 grand down to 75. I'm going to keep it at base rate here just for the flow through, just for the example. The 75,000 moves to the bucket company bank account, and ignore the fact that it was going to pay another 5 cents to the dollar. I'll do it. It pays another 5 cents to the dollar. We're doing the real example. There's now 65 sorry, $70,000 sitting in your bucket company. Jeez, you can tell that I haven't had my second coffee today. So you got $70,000 in your bucket company, and now we distribute that to, the
Yep.
adult child or your wife who, just you had another child and your wife hasn't been working. So there's another opportunity to get some money out into the family group. $70,000 of taxable income plus the franking credit gets added on top. So the total taxable income becomes $100,000 again. Now, we use that example before of what happens when you've got $100,000 of taxable income. You have to pay $22,788 in tax. Now, if I've just said you've actually got $30,000 in franking credits, you only have to pay, let's round to $23,000 in tax. You've now got yourself a $7,000 refund through your partner's tax return because of the overpayment of taxes at the company tax rate. So this is where, as long as you're utilizing lower margin brackets for the individual, you're actually getting money back in company taxes that's been paid to the ATO in previous years by utilizing those franking credits in a really smart way. And that's when, when we do tax planning and we show people, hey, last year you paid 30 grand in company tax, but you're going to get a $7,000 refund from the ATO because we're using lower margins. They sit back and go, what the hell? I get $7,000 back? Like, how cool is this? And it's actually like, they kind of see the reward for going through the effort of doing a tax planning meeting or setting up the bucket company and trusting their advisor to go through this process.
Yeah, that was the part that I
Yeah.
wasn't 100% sure of. So you'd still be individually, so your tax return would show 100 grand, you'd have your 25 grand franking credit, and then you would get a refund based on the additional tax you've already previously paid. So you're actually getting return as an individual, in that situation. So that's really good clarity around that, because that was sort of the question mark that I was sort of asking, going, well, aren't I paying maybe tax again? I know there's a franking credit, but how does that even work? So it's
Yeah,
good
exactly.
clarification.
And this is where, if you don't have one and you have a lot of income to distribute, you're given 47% every year, 47% on the upper limit. At least by creating a bucket company in your group structure, you have options. You have options that within a couple of years, you may have a year that's not as good as the ones before. So an opportunity to distribute some money from bucket company wealth into individual wealth. Then there's the side that we talked about of actually using that bucket company to invest. So if you've got, at the moment, you might be able to get 6% interest rates on a term deposit. You may have excess cash sitting in your operating company or in your family trust that you trade out of. And you go, you know what? Well, if I earn interest in my family trust and have to distribute to an individual, or if I earn interest in my own personal name, I might be giving 47 cents back to the government straight away. But if I put it into my bucket company and set up a term deposit, make 6% return on the 100 grand that I parked there, I've got another 6 grand bonus cash, but I'm then going to give 30 cents to the dollar to the ATO and then roll that franking credit again. So it's all opportunity to use those franking credits on money that's being put to work for you to benefit your family's wealth. And again, that's why, we get pretty pumped up about the benefits of a bucket company. Beyond tax minimization, there's also asset protection. So we had a real life example where another one of our tradie clients has built up $500,000 of retained earnings in their trading company. Now they work in a more risky industry where there's a lot of liquidation events, risky jobs, companies going under that sue each other or don't pay each other. And we had a tax planning meeting. We said, mate, I know you like to have the cash in the company. You do some big projects and you like to have that cash, but there's a risk that if something goes pear-shaped and you get sued, it's a pretty healthy asset sitting in your operating company, which is the risk-taking entity. So what we did with this client was to set up the bucket company. We paid a large dividend to basically clear 400,000 of the 500,000 out to the family trust into the bucket company. Client did lose the extra 5 cents to the dollar, but understands those franking credits will be made available at some stage down the track. Client also felt very secure in a sense that the extra 5 cents to the dollar that went to the ATO was an insurance policy to protect the money. Once the money hit the bucket company account, we created a loan agreement for working capital arrangements, basically that money was loaned back to the operating company. And what was registered was called a PPSR, which is a personal property securities register. So this client's bucket company has loaned the money over and will make commercial terms on interest earned for the loan between the entities. It'll pay tax in that entity on the money earned, but it also registered security. So the event something goes wrong in the operating company, there's a security that says the first person who needs to get that money back is Mr. Bucket. And that's who gets the money back first before a liquidator or somebody suing the company can get their hands on anything.
Wow. So so my read on that is you could have an investment property in your bucket if and you could negatively gear that if you wanted to as well, or is that
Yeah,
a
I mean,
dangerous game?
you wouldn't in a sense, like if you're going to have a negatively geared property and anything that can go up in capital value, you'd try and keep that in a family trust or in an
Yep.
individual. And the reason for that is capital gains tax. If it's a genuine investment, you want to make sure that you get the CGT discount, which is
Yep.
50% in our country, which is quite a lucrative
Significant.
event for individuals. So that's where a company misses out on a CGT discount. So it's actually great you brought it up. So what we try and do with it, companies that we set up bucket companies for, or people, individuals, family groups, we kind of talk about, and we're not financial advisors, so this is where we partner with Innovate to have a financial advisor come in and give all the legal advice and the above board advice. But it's passive investments through a bucket company, passive income, things that aren't going to necessarily appreciate in huge capital value, bucket company safe. But if you were going to buy a share portfolio, which was all about capital growth, you'd want to do that outside of the bucket company. Because
Yeah.
if that share portfolio goes from 100,000 to 300,000, and you've got to pay again, look, it's actually sometimes it works out. I'm not discounting it, but do the planning with your financial advisor and your accountant to decide whether paying tax on 200,000 capital growth at 25% is better than 200,000 capital growth. 50% CGT discount makes 100,000 taxable, and then tax rates at individual level in the year you sell. It's all a timing game as well. You know, these bucket companies, we're seeing people at the later stages of their business life that are going to spend the last couple of years, they've maximized their super contributions, but they've still got excess cash that they don't want to take personally at 47%. They create basically a retirement fund bucket company, and it's kind of a backup super fund where then once they've retired, they'll pay themselves fully franked dividends and get the refund. You know, if they're paying a 30 grand dividend and getting nearly a $10,000 refund on it, not bad, right? You're getting the company tax back that you paid while you're a hard-working, individual growing a company, and then you've retired, and it's your turn to get a lick back the other way after all the taxes you've paid all those years.
So you could use it as a strategy piece in retirement to funnel, not funnel, that's a bad word, but to distribute effectively once you're not necessarily making any income to a degree.
Yeah.
Interesting. Last question on it. Sorry, Tommy, I'm
Yep.
being a question hog here, but I'm just interested because it's an interesting dynamic personally. Do you ever trade out of a bucket company, or does that defeat the actual purpose of it?
Yeah, it's a great question and effectively defeats the purpose in a sense. So you always want to look at your group structure and go, where do I take the risk and where do I hold my assets? And that
Yeah.
should always be a question you ask as a business owner, in a family, all the relationships of a family. Even if you're doing business with other people as well, where are the risks happening and where are the assets being held? And, maybe for another episode, but you can even look at that where if you've got a company that's buying significant assets like vehicles and equipment, some companies set up an equipment owning company, and then you've got the trading entity that takes the risk and they hire the equipment off the other company just to make sure that if the event something goes pear-shaped in the risk entity, you're not losing all your assets at the same time. So, I mean, you're asking great questions, and I could talk about bucket companies and companies till the cows come home. So, just to kind of give you some practical things, if you listen, you're a business owner, maybe you don't have a family trust, maybe you're a sole trader and you feel like you're paying too much tax, the questions that you do have to kind of sometimes, if you're working with an accountant who's busy and maybe isn't being as proactive as you like, just ask some questions, book a meeting. Education's really important. And again, it doesn't have to be a future advisory, part of doing this is to make sure that we're empowering Australians to ask the right questions to their advisors. go and ask, should I have a bucket company? Why don't I have a family trust? And if you're not getting the right answers or feel like, you're being screwed around, then, reach out to a few other people and keep asking those questions. But, setting up a bucket company doesn't have to be overly expensive, but you should do it right. Don't go to ASIC and register it for the $576 ASIC fee, because you're not getting shareholder agreements, you're not getting company constitutions, you're not getting the shareholder statements and all the different bits and pieces, the directors' minutes, the resolutions. There's a whole bunch of legal requirements of what happens when you register a company. So go through someone who does it properly and can take you through the steps. And then that way, when you're integrating a bucket company into your family group or your group of entities, you got to make sure that it qualifies as a beneficiary to your family trust. So somebody's got to look at the trust deed, whether it's your advisor or your legal team. But if you're going to go down this path, just get it right from day one and make sure you're working with a team that you can trust.
Jace, what industries do you see utilizing something like this?
Across the board. I mean, we work pretty heavily in e-commerce, trades and construction and professional services. So those three for us, all across the board. There's examples of bucket companies. It's probably not so much about the industry, but it's about, is the business that you're working with making considerable profits, and how are you minimizing tax and protecting assets and allowing for wealth creation and growth. So it doesn't matter the industry. It's more making sure that you're not paying extra tax unnecessarily.
Yeah, I mean, it really seems like a future play with your money. And that's the funniest thing about, being a small business owner, looking on paper, seeing the difference in, it's either 70K to the tax department in the future, which I can't even feel right now. I'm not emotionally attached to that. And then there's 40K. And so you're going, well, which one are you going to choose? If you if you can save that extra cash, it makes sense. But yeah, it is a real future play, hence the your business name, which is why I like it.
Yeah.
I like it.
No, thank you, mate. And look, and that's the thing. I mean, even when we do these things, sometimes there's a year where you take a hit, where you actually take extra income, because let's say you're going for a home loan and you need to show better taxable income. You might shoot some money out from your bucket company, top up your taxable income, so that when you go and sit with Marty and the broking team and say, here's my taxable income for the last year or 2 years, depending on the bank that you're working with or the finance people that are giving you the money, you can actually top up your income with more of the wealth from your bucket company. And then sometimes they'll actually take the bucket company into consideration and say, well, that's actually your wealth. So we know that you've got some ongoing cash flow you can take from that to support servicing loans. Correct me if I'm wrong there, Marty. I might throw to the finance expert here to make sure that I'm...
It's true. And generally, it's like it's like retained profits. Like you can only use that in the year that you're making the profits. But in regards to bucket companies, sometimes at a high level, you can go on the original profit and service off that, or you can filter through. Some banks only want to see the notice of assessments, the personal notice of assessments. So you can orchestrate, depending on your individual situation, as to where you get funding and what the policies are around that. So as long as there's money there, there's always a way to showcase how that money is being filtered through.
Beautiful, mate. Thank you for your expert opinion on that. But look, boys, I've loved talking about this. We should probably revisit that tax hacks episode from episode 10 and see just how amateur we were back then with our early days of podcasting. Although we were in the studio, so we might have looked pretty slick, probably a bit younger, not so many greys in the beard. But they do seem to be quite hot topics, those episodes, when we're sharing tax tips and tax hacks, or Marty's going through numbers on the economy. Seem the influencer that he is. But if you've enjoyed the episode, thank you for tuning in. We love talking all things companies, trusts, tax returns, and making sure you're paying the least amount of tax legally possible. If you know someone in business who is paying too much tax, definitely send them this episode. It's all about education and learning what's out there for you and what your options are. But until next time,
if you want a bucket, don't go to KFC. Talk to Jace at Future Advisory. 11 secret herbs and strategies. Game over.
This podcast is for educational and informational purposes only. The conversations are of a general nature and do not qualify as financial or tax advice. We recommend before you make any financial decisions, you consult a licensed professional. Individuals on the podcast may hold positions in the companies discussed.